Joining me now, Ashley Webster, Jack Howe, John Layfield, Scott Martin. All right, guys, positive signs in the economy, positive signs in the market, near all-time highs. John, what do you have to say about it?
Look, I don't think a lot of things have changed except for the S&P earnings. Our S&P earnings are the best they've been in 6 years, but still the U.S. market is the place to be. You look at all the trouble around the world, you look at the Fed keeping interest rates low, there's not much yield anywhere else, the place to be, and look, and all the innovation is happening in the United States. I think the U.S. market is simply by comparison, and things are getting much better, is the place to be.
Scott, what do you say to those people who say, yeah, things are getting better, but valuations are extended, the rally is long in the tooth, and a lot of the Trump agenda may be pushed off into next year?
Yeah, you know, it's funny about those comments about the rallies and valuations. You know, that's been a qualm for at least the bears for what, Charles, the last 2, 3, 4 years, hasn't it? I mean, this rally was supposed to be over many quarters ago. I think John's right. I think the fuel for this fire is earnings, and I think it's also the fact of something you and Art Laffer talked about some minutes ago, which is the market is not talking about today or not looking at today. It's not looking at yesterday. It's looking at tomorrow and looking at all these pro-business initiatives that we have coming out of D.C. Finally, after 8 years of oppression to the business community, that's what this market is excited about, and that's what's going to take S&P prices higher.
Jack, 9 of 11 S&P sectors have shown accelerated growth since March 31st. Can we infer that that's the kind of momentum that can last and justify this market?
I think so. I don't see any signs of weakness right now in corporate earnings. You really needed that to justify the valuations we're seeing. But look, there are still some good deals out there. I would encourage people to look, for example, at chips, which have not been expensive. In the past, chips, you had to wait for a big upcycle in personal computers. We're now in a world where they're selling more silicon into cars. They're selling more into other devices that are networked. Chip makers have smoothed out the earnings cycles. There are some good deals to be found, I think, at companies like Analog Devices and so forth.
ADI?
Yep.
All right. Some encouraging signs from these big retail names reporting profits. Scott, is it a mirage or is it just sort of the idea that the expectations were so low, or maybe some retailers getting their act together?
You know, the expectations are definitely low. I mean, if you ask anybody about retail, at least in Wall Street, they're going to tell you that retail is the walking dead. Now, the trouble is, though, is when expectations get low and you have some of the numbers like you saw today, you get a little bit of a bounce. They're heavily shorted names. But I'll tell you, the death of retail is not exaggerated. It's probably just forced in the sense that it's not going to happen tomorrow, but is going to happen soon. So therefore, when you're in these names or looking to pick up these names, these are merely a trade. They're not a long-term hold. And if you're lucky enough to get a couple of them, a couple of beauties amongst all the minds that are in the field, good luck to that.
John, what do you think? Because some of these guys are getting their act together online, and some of them are just making it better, you know, finding ways to get us to go shop.
Yeah, look, I'm with Scott completely on this. You have Best Buy, which has found a way to counter Amazon. So has Home Depot, which I own because they are able to give instructions in the stores, which is hard to get online. But for the most part, retail has got massive problems going forward. We're on pace to close 8,600 retail stores this year. At the peak of the recession, it was 6,800 for a year. We're still selling stuff. It's how you're selling it. And not only, you know, Walmart was the retail killer. Now it's Amazon, and now those two are competing against each other. Walmart's doing some great things after the acquisition of Jet.com and Mark Lohr, the CEO that's coming on to help them with their online business. But those two together are really going to cause a lot of pain for your brick-and-mortar retail stores.
I mean, bottom line is from 1970 to 2015, malls grew at twice the rate of our population. Yeah. Maybe this was overdue.
But, you know, for instance, Guess, what is it, up 14% or something close like that? Yeah, 13.5%. Just because they're not losing money as quickly as we thought they would. Bear in mind, what's the standard here? Yes, Best Buy has done well and has put a good strategy in place, but I just think it's still a real struggle for the majority of these retailers, these brick-and-mortar stores, to stop the bleeding.
I believe in creative destruction, though. I think ultimately it's not a bad thing.
I can tell you, Amazon is very sensitive to this narrative that they're the retail killer. They don't like that story at all. They like what you said, that we just built too many stores and now we need to get rid of some and that the market will correct itself. You know, when I look at the market, I see each time Amazon decides to go after share in a new market like clothing, that industry gets killed. Clothing's been getting killed.
They just announced pharmacy, and they just announced furniture. So beware.
Hey, Charles.
Yeah.
Charles, one thing that's really important to understand is Amazon in the last 20 years, so their growth rate right now is 25% the last 2 years. If that continues the next 3, they're going to double their market in the next 3 years. So they're going to do in the next 3 years what they've done in the last 20 for retail.
All right, guys, it's just an amazing story. So is Facebook, and they're not giving up on growth either. One thing they've done is they're signing deals with the likes of Vox, BuzzFeed, and a whole lot of others, and they want to show video. Jack, what do you think? Is that the way to go?
I don't know. I like my TV personalities to be vetted, you know, billionaires like yourself, Charles. I don't want any Tom, Dick, and Harry to show up on these online streaming services. You know, this is where the direction things are going, especially among young viewers. There's so much competition.
I just saw a survey yesterday on kids 7 to 16.
Yeah.
And what do you want to be when you grow up? The #1 job? A YouTube star.
Yeah. That's all they watch. You can get anything on YouTube.
They have stars that get billions of viewers on YouTube. We don't even know their names because people our age don't watch them, but kids do.
So
all right,
true.
guys. Hey, Amazon, by the way, speaking of which, actually opening up a bookstore in New York City. And Scott, is Amazon just going back to the future? By the way, this used to be a border store that they put out of business. Yeah.
I mean, what a message. We're gonna put you borders out of business, and then gone, we're going to move into where you were because you couldn't sell enough of your product, and we're going to sell the same thing pretty much. You know, it's funny what Amazon's doing here. There's actually one, Charles, Amazon bookstore right near my house in Chicago here. And I'll tell you that the first few times I went there, it was jammed. And the reason is because they're also selling Prime memberships there. They're trying to get a lot of those Prime signups because what you do is you go in, you scan the book on your phone, you realize how much more of a great deal Prime is. So what they believe is not so much maybe the books, but this is the gateway, I guess, the gateway drug to a Prime membership, which therefore opens up tons of spending as you see come in through their Prime memberships. And that's what's going to unlock more of the Amazon ecosphere, so to speak.
All right, guys. Well, because of these hot tech names, we got a race. Amazon and Alphabet shares a neck and neck. John, I'm going to you. Which one hits $1,000 a share first?
You know, it's kind of tough because the valuations are grossly different. I mean, Google has almost 50% more valuation, about $670 billion right now compared to about $480 billion for Amazon. So hitting 1,000 first obviously is just the number. To me, flip a coin. I think it's Google.
All right, Scott, what do you think?
I think it's Amazon, and here's why. You know, when you're talking about short-term price targets like this, I mean, I think both will hit 1,000 by the end of the quarter, so that's June 30. But, Charles, just on the charts, you know, you're a chart guy, too. It looks like there's just a touch, just a barely smidge more momentum in the Amazon upside price. I'd pick Amazon to get 1,000 first before Google, and we own both. So either one works for me.
Jack, break the tie.
I've got to settle. John, I'm sorry, you're bigger, but the answer is Amazon. The earnings estimates have been plunging for the stock. That's actually a great sign. Investors love when that happens because it means that Amazon is spending money on something that's going to re-accelerate their sales growth. Who cares about earnings when they look at Amazon, right? So the stock is about to head higher.
All right, guys, let's check on the big board because, again, this could be a historic day. We're up 55 points for the Dow, well above 21,000 right now. Sort of spinning our wheels from the strong open, waiting for the next wave of buying to come in. NASDAQ, you want to take a look at that one as well. NASDAQ up 15 points. It has obviously been the juggernaut. But yesterday, NASDAQ was joined by the S&P 500, which found a way to hit a new all-time high right after that Fed report, which gave some cover to the fact that Janet Yellen more or less promising Wall Street she's not going to mess up this rally, and that got the S&P to rally big time. Of course, not everything up. Weaker sales in Hormel. They're the company that makes Spam and Skippy, so it's not my fault, guys. I'm keeping up my end of the bargain.
Not together. Those are separate products.
I don't know. They taste pretty good together, too. First you fry the Spam, and then you throw in the Skippy. Hey, sales at Signet Jewelers. It's a trip over itself. Those shares are down. Want to take a look at oil because we've got some interesting movement in it. It's below $51, and this, despite the fact that OPEC rules, this is because OPEC rules out deeper cuts, although they're going to extend the cuts that they've got going on already. Ashley.
Well, they 1.8 million barrels per day. It was supposed to run out, this production cut, next month. They've extended it through the end of next quarter 2018, so 9 months.
But
there was a belief that it was going to be deeper. The problem is for OPEC is that the U.S. and others are continuing to pump out shale oil to counteract any production cuts. Not to mention we have an absolute slew of oil out there washing. We're swimming in it right now. It's going to take a while to work our way through that. So OPEC, its influence continuing to weaken.
But, John, I mean, at what point do U.S. producers say probably should put the brakes on as well? I mean, we brought back a lot of rigs.
Yeah, we did. It's going to be all dependent upon oil prices. That's why I think we're in a trading range, because if it gets low enough, you have mainly the shale oil will quit producing, and if it gets high enough, shale oil is the one. Shale oil is now the swing producer, which is taking the place, just like Ashley said, of Saudi Arabia. And these OPEC cuts, you look at actual production in OPEC and what they say that they're going to do as far as cuts, you can't trust any of these guys.
All right, guys. Thank you all very much, John, Scott, and Jack. Really appreciate it.